Principles of Accounting 2, Chapter 14. In Chapter 14, we talk about financial statement analysis. So this is where we look at the accounting information and the financial statements that publicly owned companies put out that allow us to determine how financially stable they are by looking at key financial relationships and trends. So the classified financial statements and comparative financial statements that public traded companies put out. The classified financial statements collect assets together. So items with certain characteristics are placed together in a group or classification to help us with analysis of their statements. When a balance sheet that separates assets and liabilities into current and non-current categories is an example of a classified financial statement. A comparative financial statement is a financial statement that shows us more than one accounting period side by side in vertical columns. This is usually in years. So this allows us to evaluate changes in trends in their financial records. Generally, the standards in financial statement analysis are to have a minimum of 5 years information about a company. When we're looking at their consolidated financial statements, this means that every subsidiary that a company owns is presented as if it's a single business organization. So in this example in the textbook, Pepsi, which also owns Frito-Lay, Quaker Oats, Gatorade, and Tropicana, would just show a Pepsi financial statement. And we would have to dig through their notes to look for the amounts that were contributed by the very different subsidiaries that they own. So most companies are combined with several other companies, and that would be the case for their consolidated financial statements. These comparative income statements, we can see that we have 3 years of information that allows us to compare the information side by side. When we're looking at financial statement analysis, we usually look at 4 different techniques for that. One is the dollar and percentage changes in information. 2 is the trend percentage information. So what are our trends from year to year? 3 is a component percentage information. And 4 is ratio analysis. So we're going to talk about each one of these individually. So first is a dollar and percent change. So what was the change from one year to the next? So when we look at our example, we have information for 2016, 2017, and 2018. So we see that from 2016 to 2017, we increased $100, which was a percent increase of 25%. From 2017 to 2018, we also increased $100, but in that case, it was a percent increase of 20%. Certain percentage changes help us look at the company's rate of growth. So we typically look at the sales changes, gross profit changes, and changes in net income. However, percentage changes can create a misleading impression when the dollar amount used as a base is really small. So if we have a startup year for a company that grows very quickly and we use that base year that was their startup year, that can lead to unequal analysis. We also don't want to look at just one form of financial statement analysis and think that that shows a whole picture of a company. So say we do this percentage changes look and we see that their sales grows every year and their net income grows every year. And so we think they're a very stable company. Well, that's not the only financial statement analysis that we need to do before we can make that information. So trend percentages is the next one that we would look at. trend percentages is also called horizontal statement analysis because we're looking across a line horizontally to see a trend in change. We're comparing one item to itself from year to year. So first we select a base year, and then each item is weighed back to the base year. So when we look at this example, we have our dollar amounts for 5 years worth of information. We set 2013 as our base year. So 2013 is our 100% year, and every other year is compared to 2013. So 2014, we see there's a 4% growth from 2013. In 2018, we have a 150% growth from 2013. Component percentages is also called vertical analysis. In a component percentage, we look at the relative size of each item to a total amount. On the balance sheet, we compare everything to total assets. So what is every amount on the balance sheet as a percentage of total assets? Total assets are set at our 100% amount, and everything else is shown as a percentage of total assets. On an income statement, the 100% amount for our vertical or common percent analysis is net sales. So net sales is set as 100%, and every other item is shown as a percentage of net sales. When we're looking at those dollar and percentage changes, any trend percentages, and our other financial statement analysis, we want to be looking for standards that we can compare against. So usually what we compare against is the past performance of the company and performance of companies in the same industry. So we want to compare other companies in the same industry. So if we're looking at a restaurant's financial statements, we would want to compare them against their own history, and then we would want to look at other restaurants in comparison to them. So our past performance of the company, we're looking at that horizontal analysis, which is the trend analysis. And then vertical analysis is our component percentage analysis. When we look at industry standards, this is called benchmarking. So when we look at industry standards, we're looking at external benchmarks. Benchmarks are comparable companies. It's the average performance of companies within that industry. So we would have what the average restaurant performance is among all of the industry. What is the benchmark for restaurants, or what is the benchmark for retailers versus what is this current company doing? When we're looking at all of their financial information, we also want to know what the quality of earnings is in the rate of earnings on sales, total assets, and owner's equity. So we must look at the stability and the source of earnings. We don't want to see an erratic earnings performance over several periods of years. Anything less desirable than a steady level of earnings. A history of increasing earnings is preferable to a flat earnings record. Unfortunately, companies can be sometimes incentivized to do fraud, or what's called as income smoothing, in order to make their earnings look more stable and not flat, in order to make their financial records look more attractive to financial analysts. When we look at the quality of assets and their relative amount of debt, profitability isn't just the correct indicator. We also want to look at other things. What is the composition of their assets? So what kind of assets do they own? What's their percentage of assets? Do they have a lot of money in inventory where they could possibly lose money? What's the condition and the liquidity of their assets? What's the timing on the repayment of liabilities? And what is their total amount of debt outstanding, especially their liabilities to assets? We're looking for those measurements of liquidity and credit risk. So liquidity, remembers, is our ability to generate cash flows as our liabilities come due. So we have to make regular interest and principal payments if we have liabilities. If we purchase inventory, we need to be able to pay the people that we purchased it from. So liquidity is a very important concept in financial statement analysis. We want to make sure that they're able to pay all of their debts as they come due. A company's financial reports, publicly traded companies are legally required to file annual and quarterly reports. Their annual report has a lot of information besides their financial statements. So it has to include the management's discussion and analysis of financial conditions. So this is an item where the manager signs off on the financial statements in the report and says that they certify that they are aware of everything that's been printed in the financial statement. They need to have the report of their independent auditor. They include their financial statements and any required notes to their financial statements. This information is publicly available. Many companies maintain websites where you can find this information. You can also find this information on the SEC's website where they post the quarterly and annual filings from organizations.